So welcome everyone to another GEPL Capital's Market Outlook video. I'm Sanket Bendre from Fundamental Research team, and in today's video, we will be discussing some of the key updates that happened in this week, as well as we know that results. Discuss some of the key insights from this first quarter FY27 results, and let me share my screen so we can start the video right here. Okay, I hope this content is suitable. So initially, let's discuss some of the key updates that happened in this week. So in the most recent update, it will be on the sugar industry overall. So if you see, the government has allowed duty-free imports of approximately 1 million metric tons, which is approximately 10 lakhs metric tons of raw sugar, and this is the major intervention done by government, and it is aimed at boosting the domestic supplies and cool the record high prices before the festival seasons in India starts right ahead. So if you see, India normally imposes 100% duty on sugar imports. However, due to the due to the increase in demand as well as lower supplies and higher increasing sugar prices, the government has decided to do duty-free imports of 10 lakh metric tons of raw sugar. So if you see, this move marks India's first significant sugar imports in nearly a decade and comes after tightening supplies push domestic prices sharply higher. If you see, sugar prices have risen nearly 40% over the past 2 months due to the lower production. Now, on the second update, if you see that India is considering to raise FDI, that is Foreign Direct Investment Approval, threshold for the Cabinet Committee of Economic Affairs, that is CCA, from 5,000 crores to 15,000 crores. So this proposal aims to speed up project clearances, reduce red tape, and boost the ease of doing business. So over the last few months, we have seen that government has been doing necessary changes to increase the foreign investment within India, as we have seen that over the last 2 years, the foreign investments have declined, and as a result of that, to boost the foreign direct investment within India, the government is doing several measures, and this is one of them. On the defense sector, the defense ministry has notified six positive indigestion list at PIL, which comprises 405 strategically important items with an estimated business potential of approximately 3,000 crore rupees. And this includes 16 items for the Indian Coast Guards and 389 items for the different defense PSOs. What does this list contains? This includes land deliverable units, subsystems, sub-assemblies, spares, components, and other raw materials. Further, the ministry also mentioned that the six PIL marks another step in the government's effort to promote Atmanirbhar Bharat and Made in India initiatives. So these were some of the key updates that happened in this week. So as I mentioned, we will discuss some of the key insights from this result. Despite this result, if we see the market cap to India's market cap to GDP ratio is, if we see, it is still on the higher side, currently above the long-term average of approximately 10 years. If you see, it is currently it is at 134 units compared to 100 compared to long-term average of close to 90, 91, 95% of average. So this it is still the market cap to GDP level still remains elevated despite a good amount of debt. The next will be the valuation side. So valuations are currently quite expensive related to the rates as well. So on the upper side, if it had mentioned that equities are cheap, and the downside is equities are expensive. So what is this? It is basically the Nifty earnings yield against the average of US and India's 10-year So this based on this ratio, if you see currently, we are still on the expensive side in terms of valuation. If we compare the long-term average of 10 years. Similarly, Nifty 50 forward P, if we compare, it is still on the higher side of 10 years average of approximately 17 times. And if we see divided in 18 times of P, on a 10-year basis, so it is still, we are still seeing 50 pretty at a higher side compared to long-term averages of 10 years. So, in this slide, we are seeing that what are the changes in earnings estimates for the for the FY27 post the first quarter result. So, most of the companies have changed their estimates for post the first quarter FY27 results. This includes majority of them includes consumer services, internet companies and auto sectors, cement sectors, metal mines. These are some of the top 5 companies that have lowered their guidance, changed the guidance from previous estimates in FY26 of FY26. Post the first quarter, they have changed their estimates to the lower side. Wherever the highest side is PSU banks, jewelry companies, paints, then as well as NBFC, these are some of the 5 companies which have increased their earning estimate for FY27 post the first quarter of FY27. So these are the key insights that we were able to gather for this video. And I hope you like this video. And if you do like this video, like, share, and subscribe. GEPL Capital Fundamental Research.